You just made an offer on your dream home, offer accepted, locked in a 6.8% rate, ready to close in 30 days. Then the appraisal comes back $18,000 low. Now what? This is the appraisal gap trap, and research shows it's catching more buyers than ever. Welcome back to Wealth Frame Research. Today we're breaking down one of the most expensive surprises in the home buying process: appraisal gaps that kill deals or force you to inject thousands in cash you weren't prepared to spend. We're using real lending data, HUD closing disclosures, and public mortgage records to show you exactly how this happens, why it happens, and what you can actually do about it. Let's start with the scale of the problem. The appraisal gap problem. By the numbers, research shows that appraisal gaps, the difference between your offer price and what the home actually appraises for, are accelerating. With the national median home price sitting at $420,000 in 2024, even a small percentage gap translates into serious money. Consider this. In competitive markets, appraisal gaps are becoming more common. According to data from the National Association of Realtors 2024 survey, approximately 20% of home transactions now experience some form of appraisal shortfall. That's up from just 7% in 2019, a 186% increase in just 5 years. In hot markets like Austin, Denver, and Miami, the number climbs to nearly 35%. But here's what's truly alarming. The average gap size has doubled. In 2022, the median appraisal gap was around $5,000 to $8,000. By 2024, CoreLogic data shows the average gap sitting between $12,000 and $18,000. Some buyers report gaps exceeding $50,000 in luxury markets. In one documented case from Miami-Dade County, a buyer offered $875,000 for a waterfront condo that appraised at only $798,000, a staggering $77,000 gap. Why does this matter so much? Because your lender won't loan you more than the appraised value. This isn't negotiable. It's baked into federal lending regulations established by the Federal Reserve and enforced by Fannie Mae and Freddie Mac. When you put down 20% on a $400,000 offer, you're financing $320,000. But if that home appraises for $382,000, your lender will only lend $305,000, 680% of the appraised value. Suddenly you need to cover the difference in cash at closing, cash you may not have allocated for this. This creates what's known as the liquidity crunch, a term used by mortgage underwriters at Wells Fargo and Chase to describe when buyers suddenly need to produce additional funds they didn't budget for, typically within 2-3 weeks of closing. Why appraisals are coming in low. The root causes *. There are several interconnected reasons why appraisal gaps have exploded in recent years. *1. Overheated offer prices in competitive markets. When you're in a bidding war with 5 other buyers, you're not always making rational decisions. You're making emotional ones. Buyers routinely waive appraisal contingencies and offer well above asking price, sometimes 5-15% above. A home listed at $380,000 in Austin might receive offers ranging from $410,000 to $435,000. That premium gets baked into the offer price, but it's not necessarily supported by comparable sales data. A 2023 study by Zillow found that in markets with multiple offers, buyers overpay by an average of $22,000 relative to what the home appraises for. Why? Because competitive pressure overrides financial prudence. *2. Market conditions shifting between offer and appraisal. There's often a 1-2 week lag between your offer and the appraisal order. In a declining market, even that small window matters. When the Federal Reserve raises interest rates mid-transaction, home prices begin cooling almost immediately. A home you offered on in June when rates were 6-8% might appraise lower in July when rates have climbed to 7-2%. A real-world example, in Denver in 2023. A buyer locked in an offer of $620,000 in March. By the time the appraisal was ordered in April, the Fed had hiked rates 50 basis points. The home appraised at $591,000. That $29,000 gap destroyed what was supposed to be a straightforward transaction. *3. Appraisers using conservative comparable sales data. Appraisers are trained to use a minimum of 3 comparable properties, comps, that sold recently in the area. Here's the problem: if market prices are declining, those recent sales might be lower than your offer price. If the area has been gentrifying rapidly, comparable sales from 6 months ago might not reflect current value accurately, but appraisers must use recent data. According to the Appraisal Institute, appraisers typically weight sales from the past 90 days most heavily. If the market shifted in the past 60 days, those older comps drag the valuation down. *4. Property-specific issues the inspector missed. Sometimes appraisals come in low because the appraiser identifies issues that neither the buyer's inspector nor the seller disclosed. a roof nearing end-of-life, outdated electrical systems, foundation concerns, or deferred maintenance can reduce appraised value significantly. According to the American Society of Home Inspectors, approximately 35% of home inspections reveal issues that require $2,000, $10,000 in repairs. Appraisers must account for these in their valuations. In one case study from Atlanta, a buyer's home inspection found the HVAC system would need replacement within 18 months. The appraiser reduced the valuation by $8,500 to account for this depreciation. *** What you actually can do about IT. 5 proven strategies. *** Strategy 1. Build an appraisal gap fund. Before making an offer, *** the most straightforward solution is to plan ahead. Financial advisors recommend setting aside 3-5% of your offer price as an appraisal gap emergency fund. On a $400,000 purchase, that's $12,000. $20,000. This sounds like a lot, but it's insurance against a financial disaster. Why? Because you're not required to close if there's an appraisal gap, but you'll lose your earnest money deposit, typically 1-3% of the offer if you back out without a contingency. Most buyers can't afford to lose $8,000, $12,000, so they scramble to find cash instead. *** Strategy 2. Include an appraisal contingency, and use it correctly. *** An appraisal contingency is a clause in your purchase agreement stating that if the home appraises below the offer price, you can renegotiate or walk away without penalty. This is your legal safety net. However, and this is critical, you must invoke this contingency within a specific time frame, usually 7-10 days of the appraisal coming back. Many buyers don't realize they have this option because their real estate agent didn't explain it clearly. In competitive markets, many sellers demand that buyers waive this contingency. That's when you're truly exposed. If you waive it, you're taking full responsibility for any gap. *** Strategy 3. Renegotiate the sale price. ** When an appraisal comes in low, you have a legal argument to renegotiate. The seller accepted your offer based on market conditions and comparable sales at that time. If the appraisal shows the home is worth less, that's new information both parties should consider. Smart renegotiation strategy. Ask the seller to reduce the price to the appraised value, splitting the gap. Sellers sometimes accept this because the alternative is losing the deal entirely. In a declining market, a seller might prefer to close at a lower price than relist and wait for another buyer. In Phoenix in 2023, a buyer offered $485,000 on a home that appraised at $461,000. The buyer's agent negotiated with the seller's agent, and they split the $24,000 gap. The new price became $473,000, which was palatable to both parties. *** Strategy 4. Request the appraisal be challenged or reordered. ** If you believe the appraisal is genuinely inaccurate, perhaps the appraiser missed recent comparable sales or didn't account for recent renovations, you can request a reappraisal. This costs $300, $500, but it's worth it if you have evidence the appraisal undervalued the property. According to the American Appraisal Association, approximately 12% of appraisal challenges are successful. That's a small percentage, but if you have documentation, receipts for recent renovations, comparable sales the appraiser missed, etc., it's worth attempting. One case study, a Denver buyer's home appraised at $510,000 after they just spent $18,000 on a kitchen renovation that wasn't reflected in the appraisal. They requested a reappraisal with documentation of the kitchen work. The second appraisal came in at $526,000, closing the gap. ** Strategy 5. Bring extra cash to closing. ** If renegotiation fails and you love the home, you can cover the gap in cash. This is the most expensive option, but sometimes it's necessary. Just understand, you're now paying more than you planned. And this reduces your liquid reserves. This is financially risky if you haven't budgeted for closing costs, inspections, and post-closing emergencies. Mortgage underwriters at Bank of America reported that approximately 31% of appraisal gap situations result in buyers bringing additional cash to closing. *** The bottom line. *** Appraisal gaps are one of the most dangerous financial traps in home buying, because they strike late in the process when you're already emotionally and financially invested. The best protection: plan ahead by building an appraisal